equal to equity. There is no second view about that, and this is the core principle, this is the core science, it does not change. And similarly, if you expand the second part, equity is asset is equal to equity plus liability. So on this basis, or on this thing, you will be able to calculate a certain illustration that we will discuss later on. And assets are either owner's equity or summation of owner's equity plus third party liability. And similarly, the another equation is profit and loss equation, revenue minus expenses is equal to net income or profit. So we generally use, rather than net income, word profit, because there is a confusion. Now we will take book. I hope you all carry the book. You open page number 13, please. Page number 13, please. So there is an illustration, number 1.3, which presents the December 31, 2005 balance sheet of a company. There are only two transactions, equity and liability. So an entity need cash, equipment and other resources in order to operate. These resources are assets. Assets are valuable resources owned by the entity. The left side of the balance sheet shows the amount of these assets of a certain date. It means balance sheet is a snapshot or a static statement on a particular point of time. It means once one more transaction take place, the scenario of balance sheet will be changed. Similarly, another term that is very important is retained earning. We have seen that what is the profit will be transferred to the owner. It is, if it is kept in the business, it is not the retained earning, and third party will get the exact amount of their claim. It means creditors will get 500 rupees, because as we have seen, the third parties are required to satisfy first, and if there is a balance, then that balance is going to the owner, that is the residual claim. Therefore, in the liability side, the third parties are more precise in terms of satisfaction of liability, while the equity holders will get more or less. It depends. So it is not always possible to get exact equity in case of owner's equity. And this is the result of dual aspect concept that we will discuss at a later stage. Now again we will look at what are the objectives of accounting. The objectives of accounting are 5 that we will spell out in the next lecture, but it should fairly reflect the true substance of the business and the results of its operation. Now what is the meaning of true substance means what is the value in the mind of the stakeholder is important rather than what is the actual cost paid. Say for example, if you purchase gold and you paid cash 1 lakh rupees, on your balance sheet side it will show 1 lakh cash has gone and 1 lakh rupees gold came in. But at the end of the day, on making test, if you feel that the gold you have brought for 1 lakh rupees is fake, in that case the transaction will not be like 1 lakh rupees gold and 1 lakh rupees cash. That will be recorded as an expense, that will be recorded as a loss. Therefore, rather than looking the form of transaction that was 1 lakh rupees gold, we will look what's the substance in that. So theory of accounting has therefore developed the concept of true and fair value. So true and correct has a little distinction between that. Correct is always a quantitative measure, while true is a kind of a qualitative measure. I will give one example. Say for example, in a village for year 2005 profit was 10 rupees, and for 2006 the profit was rupees 20. We can say that the profit was double, or there is 100% growth. You take example of an urban center where profit was 1 billion rupees